Hi, this is Damien Qualter with this week's property news and views for week ending 10th of July 2009. First of four articles this week being buy-to-let investments funded by redundancy payments. A survey of over 35% of finance professionals would be tempted to invest a redundancy payment to invest in a buy-to-let property, according to new research from Property Earth, the chain-free property portal. While 30% of finance professionals would use redundancy payout to cover everyday living and costs, property is the preferred outlet for those looking to invest a lump sum. Second article this week is a very bullish article. UK property prices to grow by 17% by the end of the year. Obviously, we've seen the green shoots of recovery coming, rises in mortgage approvals, and the influx of first-time buyers. But now here's a piece of news which is very, very optimistic, with predicting that annual growth for house prices will reach 17.3% by the end of the year. Obviously, this is probably the most undoubtedly optimistic forecast we've seen. Some experts are predicting that the market is now bottoming out. This is obviously what I've been saying for some time now. And one company has gone a step further and predicted a rise in prices that would be thought to have been impossible a few months ago. By the end of last year, property values had dropped approximately 22%. Very bad news for anyone investing or trying to sell the property. Now halfway in 2009, the market's picked up, and some experts saying are turning their previous dire predictions on their heads. Economists at Property Agent Assets have said that there is significant positive growth is likely, and highlights of prices rising by almost £2,000 a month for the rest of 2009. Third article today, buy-to-let cautious note. Obviously now we're talking about the various opportunities that are beginning to show and emerge in the rubble of the collapsed housing market, but investors keen to buy property again and taking a much more savvy approach than they did 2 or 3 years ago. Obviously with saving rates at a very all-time low, new investors are looking to the housing market, seeing that it's past its lowest ebb, and offering both a decent return on the money and a decent degree of certainty over the long term. One letting agent, DJ Alexander, this week reported the interest from property investors has grown significantly over the last 3 months, and it's claimed that investors are enjoying annual yields over 6.5% on properties in Edinburgh. It was a preoccupation with capital growth for many years for amateur landlords, Jim Parker was saying, who's chairman of the National Association of Landlords in Scotland. But he thinks that amateur landlords get caught in a frenzy and they piled into a market too quickly. Now that the bubble is not entirely burst, but the bubble has been deflated, research is showing that they're looking now for more in terms of yields and returns and income really over the short term. Obviously going back to a much more traditional approach to buy-to-let investing. Final article this week, house prices rise in June. UK house prices rose by 0.9% in June, according to the latest survey from Nationwide Building Society. It said it was the third rise in the past 4 months and shrank the annual rate of decline to just 9.3% from 11.3% in May. The increase in prices during the last month means that the average house now costs circa £156,000, which is approximately 15% less than £15,000 less than a year ago. The Nationwide has said this stabilisation was a welcome surprise. Since a recent low in February of £147,000, average UK house prices have measured by the UK have risen by nearly just over £8,500. House prices have risen over the last 3 out of 4 months, suggesting that improvement has begun to show up in March represents more than statistical noise, said Nationwide's economist Martin Gorber. What is unusual about recent trend reversal, however, is that it's taking place against a background of transactions activity that is still very low by historical standards. Again, 4 articles today, pretty positive articles, and I hope what I'm telling you today is giving you the confidence that property is certainly a very, very viable investment at the moment, and always has been, and always, I think, in my mind, will be, provided that you are in the market for a long period of time, and I would say a minimum of 5 years. And you're not really one of the speculators who is trying to flip properties or anything like that, because I don't think that market is no longer viable. Looking at the property going forward, my predictions are, again, we're in middle of July nearly now. I think that house prices will continue to edge forward, stabilise, and I would think that a lot of the drops in prices would have been recouped by the end of the year. My prediction is by the end of the year we will see probably house prices will have fallen about 5% from previous highs. So I'm predicting approximately another 3 or 4% increase in prices, taking them back to probably 4 or 5% below what they were at the recent highs in 2007, 2008. That's it for this week. Look forward to speaking to you next week.